You have 50 years of experience in retirement planning. What are the best options for somebody that's self-employed? And then let's compare them to like somebody that's working at a corporation. So let's start with somebody that's self-employed. I know there's like, you can use a Roth IRA, SEP IRA if you own a business. So let's start with the options for a self-employed person, then we'll work over to versus like somebody that works at a corporation. So what are like accounts for somebody that's self-employed?
Yeah, if somebody that's self-employed, they can do a SEP IRA. That would probably be the best route, and then kind of build from there. In terms of options, I would say 90% of our investment options. One of the options is the S&P 500,
Okay.
which is the top 500 companies in the country, and that's always a good place to start. And then if you have roughly 25 employees or so in that neighborhood, then we would suggest doing a 401k plan. And the 401k plan, I think the advantage of a 401k is you offer matching funds. The employer can offer matching funds, so that, for example, if an employee put in $1, the employer would match it maybe a quarter on $1 or maybe 50 cents on $1, and that which provides incentives for a participant to contribute
To plan to retire, yeah.
And that's kind of, and then what we do as an advisor then is to monitor those assets for the employer, but then also provide communication services to the participant. So we watch them. We basically monitor their investments, their investment choices. But I think we also provide a way a sounding board for our customers, so that they don't let their emotions get away from them, especially when the markets get really turbulent.
Right.
The first thing when the markets go down, the first thing the average participant wants to do is sell, and we say just the opposite. When the market goes down, historically, it's probably a pretty good time to buy, not to be selling. But also means you have to have some cash on the side to do it.
Interesting. So you'd suggest like somebody that has 25 plus employees, that's when like a 401k would maybe come into play.
Yeah.
Okay. And setting that up, they'd come to like an advisor like yourself to set up a 401k?
In most cases, yes.
Okay.
Yes. And then you have an outside record keeper that keeps track of the quarterly reporting and so forth, and contributions and whatever. And they also act as a custodian. So everything we do here at Spectrum, we don't collect any assets from any participant, whether it be an IRA or a 401k. All the assets are collected by a custodian. And in the custodian world, one of the largest custodians is Charles Schwab, and we've used them. And then in the 401k, there's probably 20 different record keepers that we've used.
Okay.
To maintain the records of a 401k plan.
Gotcha. So they're like an intermediary. So you guys like use them to invest the money kind of thing.
Yeah.
Okay. So
Yeah.
Charles Schwab would be, or like Fidelity.
We direct where the money goes, but then they actually do the investing.
Gotcha. Okay. And then what are some options for somebody that works at a corporation? I know putting money in a 401k would probably be a good idea. What would be like, I've never heard of profit sharing. I don't know much about that. What's that option?
Generally, what customers will do is they have a 401k matching option, and that's kind of the core of a 401k plan. So, and typically, if an employee puts in 6%, the company will come back and match it 50 cents on a dollar. So if the employee puts in 6%, the employer would put in 3%. That's a typical matching program. But then in addition to that, you also have a profit sharing program that you can add to that as a supplement to the 401k plan. And it is based on the profits of the company. So at the end of the year, you can say, hey, we did pretty well, so let's kick in another 3 or 4%, or let's not do anything this year because we didn't make a profit, or this profit was too small. But it's a way to add an extra kicker to a 401k plan.
Okay. And so a 401k, I need to understand this better. So like, I thought the company had the 401k and you just have to like go to your company and be like, hey, I want to contribute this. So the 401k would be like here with you guys and the company would choose you. And so the customer would have to come here to contribute? Is that kind of how it works?
Actually, the customer, we go to the customer.
Okay.
So we service 401k plans in 33 states, and so we have roughly 160 some 401k plans, and 150 to 160 401k plans. So we will service all of those 401k plans on site. So the customers have the option to come here, but in 95% of the cases, we go to the customer. On wealth management, it's I would say most of our wealth management customers come to our office, but on the 401k side, we will go to them. Our largest customer is in Atlanta, Georgia.
Really?
So we'll fly down there and visit with those customers, with those that not only with the plan sponsor, the employer, but also the participant.
Okay, so if they want to contribute to a 401k, they give you their money, and then do you have to go to the company to get like if they match it?
Yeah. So
Okay.
so what we do is we sit down with the investment committee of the company and develop a game plan. Okay. What custodian are we going to use? What record keeper are we going to use? This is our suggested lineup of investments. Are you okay with that? How about your matching funds? What are you going to do there? So it's really developing a game plan for your retirement plan. But once we have that with the employer, from there we go to the participants and communicate it to the participants. So we do employee meetings, and then we follow up with our employee meetings doing one-on-one investment advice for as many participants as we can.
Okay, so is it the same thing for those 401ks that there's an advisory fee associated with that, or does the company just pay like an outside source, like an advisory like yourself, to come in and set up the 401k kind of thing?
In most cases, on a 401k plan, we collect an advisory fee, but it's usually paid out of plan assets.
What does that mean?
So the plan sponsor, once in a while, we'll have a few plan sponsors that the employer will actually pay the advisor fee, but in most cases, the advisory fee is paid out of the 401k plan assets themselves.
Okay.
So if you had $1 million of assets in a 401k plan, we would collect right from that $1 million and not have to build we build the plan, but we don't have to build the plan sponsor.
Okay. Gotcha. And
The plan sponsor gets a copy, but they know that it's being paid out of plan assets, which is probably the case with 95% of our 401k plans.
okay.
Most of our revenue is paid out of plan assets.
Gotcha. So that's like, where they'd pay it just straight out of the account.
Yes.
Gotcha. Would that be same for like a Roth IRA, SEP IRA, same thing?
In most cases, yes.
Okay. And those are, so Roth IRA, SEP IRA, just to kind of sum it up, best options for somebody that's like self-employed, doesn't have 25 plus employees, so they wouldn't want to offer a 401k yet. So those are like their two options to invest.
Yeah, and the Roth certainly you can provide, you can buy a Roth on the IRA side as well as a 401k side, but you lose the deduction when you work with a Roth. So a lot depends on your cash flow. If your cash flow can afford you not having the deduction, we highly recommend a Roth. But if your cash flow can't handle it, then just go traditional. What a lot of our customers do is, especially on the 401k side, they'll put half of their money in a traditional 401k plan where the contribution is deductible, and the other half into a Roth where the contribution isn't deductible. But the upside is when you retire, you don't have to pay tax on the Roth portion because you already paid the tax up front.
Mm-hmm. And is there a certain age is that like 55 for the Roth or 65?
It can be any time.
You can pull it out anytime without paying tax.
Okay. Pulling it out of the Roth?
Yeah.
Usually a Roth is 55.
Okay.
But we or at least 10 years after you've contributed.
Okay.
But I would say the Roth, ideally for a Roth, you're whether it's a traditional 401k or a Roth, the idea is to hold it to retirement.
Right.
And not use it as a piggy bank.
Right. Correct me if I'm wrong, but at first I thought that a Roth, like you had to wait until you're 55 to pull it out, but you could pull it out like as much as you contribute without a fee. Is that correct? But then like any of the interest on top, that's when you'd pay like any interest that you've accrued or like gain that you've made in the account, that's what you pay the fee on top of. So you could pull it out like as a piggy bank But you technically wouldn't want to.
You could, but you have to wait 10 years to do it.
Okay, so 10 years is like the cutoff point?
But I would not use a Roth as a piggy bank.
Right.
I think a Roth should be more of a long-term hold. Mm-hmm. And what our astute investors do is when they retire, they will start converting a lot of their assets to a Roth, which means that their heirs don't have to pay the income tax. They've paid the income tax.
Just explain that again. My mind isn't comprehending it.
So we have some customers that when they retire, they'll have a lot of money in a traditional 401k plan.
Okay.
And what they'll do is over time convert some of that money from a traditional 401k plan or an IRA to a Roth.
Okay.
But when you make that conversion, you have to pay tax in the next year. And so a lot of our customers that are more well-to-do, they rather than for their heirs to someday have to pay the income tax, they will pay the income tax for them.
And leave that money for the next person, for
the next
the
generation.
beneficiary? Okay.
Yeah.
Huh, interesting. I didn't think of it that way. So yeah, they're taking the hit up front, but then for their future generation, they're not going to have to pay the tax on it.
Right, so then for future, so to the benefit of the next generation, you would want your parents to convert their assets, retirement assets, to a Roth.
To a Roth. Interesting.
And then they paid the tax.
I'm going to go home and tell them it. Right?
Go home and tell your dad, you have to convert it to a Roth.
We have to convert now, yeah.
We got to convert now.
Let's convert them to a Roth now. I want the money.